Our next guests both lowering their price targets on the stock, but maintaining their buy ratings. We're joined by Cowen's John Blackledge and MKM Partners Rohit Kulkarni. Thank you both for being here. Maybe we start with you, Rohit, on this idea of obviously paring back your price target, but maintaining that buy rating. Do you think things will get worse before they get better, and you see this as a longer-term secular play for investors?
Yeah, things are in a cyclical air pocket right now. I think the cyclical air pocket is slightly more stronger in Europe, and that's where we were wrong. But the way Amazon is disciplined on costs, the way they're talking about CapEx, the way AWS build-out is happening, and efficiencies on fulfillment centers are expected in early next year, they're setting themselves up for a really positive share gaining across all lines, advertising, commerce, and cloud, in the first half of 23 into 23, and that makes us more positive on Amazon. This is a cyclical air pocket, and that's why we are buyers of Amazon right now.
John, I want to get your thoughts on that as well, because this is the second time this year that results have significantly caused a sell-off in the stock. The same thing happened in April due to weak second quarter guidance, which spurred about a 14% drop in the stock. CEO Andy Jassy did mention a tough macro environment. Do you think it's purely macro, or do you think there are more idiosyncratic aspects at play here that management, the C-suite, could be doing a little bit better?
No, I think it's mostly all macro, really. They called out the weaker consumer demand, kind of more so in Europe than in the U.S. And also companies are looking to control costs, which is macro oriented. And you saw that show up at AWS and also a little bit in the ad biz towards the end of the quarter. And then that was implicit in guide. So mostly macro. The other thing I would say is that there's still kind of lingering kind of investment, issues that are impacting margins, but it's getting better. I mean, they told us, they're going to lower their fulfillment investment CapEx by $10 billion this year. So they're doing things that to try to kind of rein in cost, improve margins. That's why we have margins doubling next year, and we have investments declining next year, and that's why we're there for it, and we stick with it, outperform as well.
Rohit, kind of looking more into the macro environment, obviously, one thing that caught investors by surprise, perhaps, was this idea that fourth quarter guide came in far weaker than they had anticipated, than the street had anticipated. This quarter is important because it comprises the holiday shopping season. Can we extrapolate any kind of potential weakness there? Any thoughts about at least Amazon's expectation about the state of the consumer?
Yeah, absolutely. I think what Amazon is telling us is probably Europe is already in a recession, as in the way they talked about what happened in September, the trend line in October, and the gap between kind of U.S. and international commerce sales, that's been widening. International commerce sales have been kind of flattish dollar amount. Of course, there is FX there, but when it comes to Europe, I think they're declining on a year-on-year basis more rapidly. And that's what's happening in Q4. And that's U.S. consumer is doing well. I think U.S. E-commerce is probably accelerating or holding where it was. Europe is much more worse than what we thought it would be. And that's an ominous sign for more companies having that exposure. U.S. dollar is obviously affecting that.